Hassan. I am going to be also chairing this session. I welcome you all to this session by the University of Torino. The paper that I am presenting today is something which is of a legal analysis, which is based on AI, on the concept of buy now, pay later, or BNPL. I'm trying to kind of condense the whole thing into a couple of slides so we can keep the housekeeping of 15 minutes for each speaker, and we can wrap up the session. If you have any questions, you can either email me separately, or because we have less time, or you could email the lead author, Professor Klemens, for whom I'm filling in today. I'm a lawyer and, of course, qualified in English law, but I do also provide services for Islamic law. Buy now, pay later is nothing new. It's a concept which has been around for a long time. It provides basically the buyer the facility to defer payments through a service provider. And of course, that takes many forms. For example, it's a short-term financing for consumers. Everyday items, groceries, appliances, you're using your credit card, you're using virtual cards, online payments. And of course, it's also now being provided to businesses, sellers, buyers, and right now this is the US dollar 4.8 trillion a year service. So what we see within the landscape shortly is that you got various type of intermediaries, and this is kind of spread all over the world, where companies which are facilitating between the buyers and sellers. There are companies which facilitate the financial institutions like PayPal and various other services, the firm. And then, of course, you got credit card companies that actually are the ones which are paying the seller upfront, and then the buyer is making deferred payments to them. So this concept, as you can see, the Chase, Visa, Klarna, depending on which part of the world you're in, these services are being provided. Now, Islamic finance, of course, is it has various challenges when you are trying to conform to the Sharia compliant services. As you, I'm sure, all are aware that all Islamic finance institutions, especially here in the West or in the East, they are mostly governed by Sharia boards. And those boards are responsible for looking at every product and making sure that those products are in line with the Sharia principles. Primarily, there is no riba and there is no speculation or error. And so, with that being said, there are certain challenges within the Islamic finance transaction instruments that we have, for example, murabaha, musharaka, ijara, istisna, mudaraba, tawarruk. So all of these products and services which are Islamic finance compliant or Sharia law compliant, they can help in BNPL. As we look at we use AI tools to look at the literature and kind of use those tools to go through the research. We came to the conclusion that right now the Kingdom of Saudi Arabia is at the forefront, and Sema, which is the Saudi Arabian monetary authority, they actually have allowed this to be one of the key products that the bank is, central bank is right now regulating. Through the AI tools that we used for the research, we found that murabaha comes out as one of the most closely Sharia compliant products for these particular services. And so murabaha, it basically provides for the tool provides for requirements in terms of goods and services, which is that it has to be Sharia compliant, no riba, no gharar. Whereas, as you know, in most of these buy now, pay later schemes, there is an element of interest because it's a deferred payment. And then, of course, there is speculation in terms of neither the seller is not actually buying the product. It is the end user buying the product, which is against, or it violates the principle of Sharia law, in which the seller must be in physical or in some form of contractual possession of the commodity that is being sold to the seller. So that really poses a huge challenge within Islamic finance. So to go about it, of course, we looked at the literature and we found that Murabaha and Tawalliya, which is financing through no cost plus structure, they do perhaps provide an opportunity here. In Murabaha, as you know, the buyer seller must agree on markup, cost plus price, primarily financing purchases that are at the request of the buyer, and it is becoming kind of the default form of Islamic finance contracts that we see going on all across the world. But the major question that is raised here is that whether Muraba is distinguishable from the interest-based financing, which is mostly part of the buy now pay later, and we found that by Bitamam Ajal, which is BBA, another name for by Wajal, which is deferred, is the preferred form in this particular case. So Bayal Ina also occurs when the financier purchases an asset from the customer on spot. Then the asset is sold back to the customer, which is really the concept which banks are using in this case. So although in Islamic banking and finance, it is claimed that it is equivalent to a rouse, which is really the seller is not actually buying, they're only facilitating the buyer going through this process. One of the challenges that we also saw through literature is that there is a controversy in terms of how the North American, like in the MENA region, Middle East, North Africa, the application of Islamic finance rules through the Sharia boards are slightly different than what's happening, for example, in Malaysia and Indonesia. Give you an example, recent Malaysian Court of Appeal hearing in which Belena was held up as a Sharia compliant procedure, which is not recognized as a Sharia compliant procedure in the MENA region because of the hidden interest in Belena. So with that being said, what is then this Sharia compliant framework that we're looking at in terms of Murabaha? First of all, this is the legality through which the merchant has a clear, structured cost plus financing model for the client to buy. And it is also complying with Tawalliya, sale made with neither loss or gain to be share compliant or relative to PNPL. And then legally, from the point of view of contracts, there are two distinct contracts in this case. First is an agreement to purchase the goods and services from the merchant, which is Musawama. And second is a wakala, which is the mandate agreement between the seller and the purchaser or the end user, which is in some case the customer or the company, for example, Visa providing that service. And so this AI legal framework, which is being used within the fintech for most of this BNPL, especially in Saudi Arabia, it allows to automatically compile various contracts and facilitates the service providers to execute this. And these contracts are auditable by the financial regulatory authorities. And so this is being practiced right now, meaning thereby with the two distinct contracts, one based on Murabaha, Musawwama, and the second is a Wakala. So this is currently being found to be a Sharia compliant contract. Is there a wider use of this framework in the Western financial system with a pinch of salt and caveat? No. We do find that in the UK, there are certain institutions which are providing this Islamic finance compliant service. But let's say in North America, for example, in Canada and US, we do not have the facility to offer any of these contracts to our clients. So we are kind of not able to execute these contracts in its present form of the two contracts based on Murabaha and Wakala. In Middle East, North Africa, there's a limited application of this in UAE, for example. Dubai is an example. They have access to these services. Of course, KSA is at the forefront. They're also using it for their small business enterprises. So one of the examples, of course, is that I've just is up on the slide. Merchant wants to sell the goods to a provider for a specific price, Musawwama, and then they are subsequently resold to the client with a price plus markup, which has to be extremely clear. You can't have a markup of 5% now and after 2 years say, we're going to hike it up, which is usually the model with most of the virtual or real-time card services that you have, that they can, if the central bank raises the interest rate, so the APR also goes up, which is not the case in Sharia compliant products. It has to remain the same. And then the BNPL provider represents the keel of the client. So that's Wakala transaction. And finally, over time, the client pays the provider for goods, whatever is the specified period. By the way, in non-Sharia compliant cases, that period is flexible, but in Sharia compliant contracts, it has to be specified and it's kind of blocked in. This is, I also want to highlight that a BNPL or the Sharia compliant component of this is, it's not like really an Islamic tenet of law. Contractum trainus, which was adopted by during the Roman Church's ban on interest-bearing loans in the Middle Ages. So Trinius contracts were applied by Medici Bank. They were used to circumvent the kind of church's prohibition on interest-based loans. So really, the Islamic finance is interconnected. So it's like over time, the theological legal systems, they're intertwined, whether it was from Torah or from the biblical times to the Islamic times. So they're all kind of interconnected. And it is a powerful tool, no doubt, BNPL, that can create enormous financial value for Muslims. Right now, it's kind of taking up. But of course, this is an ethical framework which limits the financial institution's ability to violate or abuse the customer's ability to pay in terms of hiking up the interest rate. So perhaps we will see changes in the Western legal system that can allow for these services to be rolled out to consumers who are interest averse because of any theological or moral reasons. And that's all I had to say. 37 seconds left. I would like to invite questions at this time, or you're welcome to read the paper and send me any questions you have. And thank you for your patience. And I will invite our next speaker, which I believe is Ilinka, if I'm pronouncing your name properly. The possible. Yes.
Yes.
Welcome. Please.
Thank you.
You're welcome.
Would you upload my presentation or?
Yeah, I can upload it. Give me just
or
1 second. Oh, you can also share if you can share if you have it on your desktop, or I can share it for you. Just give me a moment here.
um,
It'll
okay.
take me like
Yeah,
30 seconds.
I think
Yeah. Okay. Yeah.
yeah.
We see it.
Yeah. Okay.
Please. Hi.
Um, Dear online delegates, it's my honor to present my paper, Possible Transformation of Islamic Banking Industry in Light of Fintech. The Gulf Cooperation Council or GCC countries' Islamic banking assets share remains the highest, or 57.6% in 2021. Middle East and South Asia or MESA region has second position, and Southeast Asia or SIA region has the third largest share. Africa region has the smallest share of 2.8%, but recorded the highest growth rate of 35% among the 5 regions. The growth rate of Islamic banking sector in 2021 was mainly due to merger and acquisitions, opening of new Islamic banks, and the increase in oil prices, especially among jurisdictions with systemically important Islamic banking that are oil exporters. Global fintech investments in 2021 reached 210 billion US dollars, with growing interest in cryptocurrencies and blockchain, wealth tech, and cybersecurity. Fintech activities could be divided into 6 types: payments, digital lending, digital banking, digital investment and personal finance, blockchain, and insurtech. Payments dominate fintech investments in 2021, both in mature markets like the USA and UK, and in emerging markets like Africa, Latin America, and Southeast Asia. It was driven by acceleration in digital trends and increasing demand for alternative payments models like buy now, pay later, for which we heard the beautiful presentation earlier. In China, Kenya, and South Korea, fintech and big tech rates are much larger relative to GDP, while in USA, Japan, and UK, fintech and big tech lending in absolute terms is large, but equal less than 1% of the total credit volumes in 2018. China is the largest market for both fintech and big tech credit, as presented in the figure. Big tech companies in China lent 363 billion US dollars in 2018, or 2.6% of GDP. And in Kenya, they lent through mobile money providers 1 billion US dollars, or 1.1% of GDP in same year. The Organization of Islamic Cooperation, or OIC's countries' Islamic fintech was historically estimated to reach 79 billion US dollars in 2021. Malaysia, Saudi Arabia, Indonesia, the United Arab Emirates, and the United Kingdom are the top 5 ecosystems of Islamic fintech in the world. Indonesia is considered the fastest growing fintech ecosystem in Southeast Asia. In general, finance and save and invest account for 80% of total Islamic fintech. In general, capital markets and Sharia-compliant insurance categories are underdeveloped globally. Wealth management and alternative finance are considered maturing segments with less expectation for high momentum in future. Payments are an underutilized opportunity in developed global fintech markets. The online banking penetration is estimated to reach 68.16% in 2028. Europe had the highest number of digital banks worldwide as of 2022, whereas Middle East and Africa had the lowest number of digital banks. In Asia, in contrast with the rest of the world, Digital banking is run by consortium or established companies. Digital banks in China have around 5% of consumer unsecured loans and 7% of SME online loans, as my bank has more than 20 million SME customers and we bank around 200 million retail clients. In 2019, not only digital banks were profitable in China, but WeBank and XW Bank had ROE higher than the average one for all banks. In contrast to banks that are more product-centric and slower at innovation, fintech and big tech firms generally have a different business model, as they have little to lose, can innovate rapidly, focus on interfaces that maximize customer experience, and have huge built-in economies of scale. There is also difference in the lending process. A traditional bank first finds the funds mainly from deposits and then lend, where the process in big tech companies is the opposite. Customers of big tech companies also maintain seizable balances or floats with them in order to use their payment services without receiving any interest on them. At the same time, big tech firms deposit these funds with banks and earn interest. In addition, banks and fintech companies face different regulatory costs for similar activities because they are subject to different regulations. Big tech firms can adopt fintech innovations much more easily as they already have a digital platform in which they use innovations can be incorporated. This comply with the findings that it is more difficult for older companies to innovate in comparison to younger ones. There are key differences between the determinants of fintech and big tech credit. Banks' margin and regulation are important for fintech credit, but not so much for big tech credit. At the same time, fintech credit has negative impact on banks' net interest margin. Fewer bank branches per capita contributes to better developed fintech credit. There is a positive relationship between GDP per capita and fintech and big tech credits, but relationship is stronger for fintech than big tech credit. Further, Cornell et al. Found negative correlation between the density of the bank branches and fintech credit, but not for the big tech credits. Adrian and Mancini-Grifoli in 2019, by exploring the future of the conventional banks in relationship to digital money providers or e-money, proposed three possible scenarios that are adopted into the Islamic banking landscape based on region's diversity and further edited in this research. First scenario is complementary existence between Islamic banks and fintech, where fintechs could complement Islamic banks. This is the most likely expected scenario in Africa region, where fintechs can draw poorer households and small businesses into the formal economy, familiarize them with new technologies, and encourage them to seek credit and more complex saving instruments provided by Islamic banks. The region has witnessed several developments highlighting its significant potential for the Islamic banking industry. Second possible scenario is coexistence. This is one of the scenarios which could be expected to be adopted in GCC region. Clearly, from the bank standpoint, such a scenario is not optimal because Islamic banks will need to exchange some cheap and stable retail funding for expensive and runnable wholesale funding, to disconnect some client relationship, and as a consequence to lose access to valuable data on customer transactions. In addition, a significant portion of Islamic bank financing is based on illiquid asset-based equity contracts with deposits in the form of callable investment accounts. There is a chance to be seen the adoption of both second and first scenarios in MESA region. Third possible scenario is takeover. This scenario, even the least possible one, considers a radical transformation of Islamic banking model, whereby banks mostly rely on wholesale funding and credit is increasingly intermediated by markets. Key challenges that could lead to the third scenario are limited awareness, understanding, and demand for Islamic products, the smaller capital base of Islamic banks, limited product offerings, and limited skilled staff. Fourth possible scenario is digital transformation of Islamic banks and merger and acquisitions between Islamic banks and with fintech companies. This scenario could be expected to be adopted in CEE region as well as one of the possible scenarios in the GCC region, especially as big techs are becoming economically significant in parts of Southeast Asia, which have access to data that banks and fintech firms do not have, and at the same time have the scale the large banks have. The prospects for further growth of the asset of CEE Islamic banking sector would be driven by the huge underdeveloped market, especially in Indonesia. Fintech inclusion leads to reduced default and leverage risk in Islamic banks. The most adopted technology by Islamic banks is mobile payments as presented in the figure. Islamic banking fintech inclusion is faster in South Asia and Sub-Saharan Africa, with the highest percentage in Malaysia. There is a tendency of banks mergers with fintech companies in order to compete with big techs. Fintechs are in general profitable, especially in payment services, but struggle for rich financial sources, which impede their growth with few exceptions. As per UNITA, digital transformation could improve Islamic banks' profitability with 63.64%. There are some short points related to the research, as there isn't a well-developed official reporting for the new digital lending, excluding data on credit to the private sector and some on fintech. In contrast, data on big tech credit is very fragmentary, excluding the work of few researchers. In addition, the future also could bring very different scenarios if central banks allow non-bank fintech companies to hold reserve balances with them. Such a step could help fintech companies to overcome market and liquidity risk and boost their activity. This topic is not new. For example, Swiss National Bank, Hong Kong Monetary Authority, and Reserve Bank of Indonesia already offer licenses subject to an approval process for non-bank fintech companies to hold reserve balances. In addition, Central Bank of China requires large payment providers to hold in client funds as reserve at the central bank. Thank you for taking your time and watching my presentation. Thank you. Sorry, I can't hear you.
My apologies. My apologies. Thank you, Ilinka, for your very informative presentation. I think all the four scenarios that you have described in your presentation of fintech becoming all-embracing are very relevant. The presentation was very well researched, and I hope that all of our colleagues would be able to reread it. And if they have any questions, in the interest of time, I'm sure they can send them to you. I did find some of the points there that you've raised, especially with the adoption of fintech within the conventional banking system and kind of linking it with Islamic banking are very relevant. For example, in my own research, I found that China has used fintech to its advantage, especially in the Islamic finance and banking sector. So thank you once again.
Thank you
And
so much. Yeah.
thank you. And I will now invite Karim. Karim is here. Hi, Karim.
Hi, can you hear me?
Yes. Are you able to share your presentation or do you need any
Yeah,
assistance?
I will share it right now.
Perfect. Thank you.
Just apologize for my late entrance.
It's okay. We'll send you a bill. Don't worry.
Yeah, I'm sharing it right now. Please let me know if it's clear on the screen or not.
Yeah. I hope everyone can see that. Yeah. Good.
Okay, you can see it. Uh,
If it's taking some time to upload, I can upload for you. Is that okay?
yeah, it doesn't matter. Whatever it suits you. For me, it's okay.
Yeah, because I think it's taking sometimes. Could be the internet connection. Yeah, you can unshare it and I can do it from my end.
I'm stopping it.
Perfect. All right, let's see here. All right.
Yeah, that's
Here
it.
we are. Perfect. Good to go.
Yeah.
The floor is yours. Yes.
Okay, I can introduce the topic, which is the adoption of the cryptocurrencies in the Islamic economies. As you know, this topic is like very trending. The usage and the demand on cryptocurrency is happening everywhere. So it's interesting to know what is the point of view from the Islamic finance perspective, and also what is the challenges, the obstacles that's facing these applications in the Islamic world. So we'll have like an introduction for the topic and then the literature followed by an analysis of the evolution of the modern banking system between the Western and Eastern economies, because it's not the same. Some economies like in Italy and England started far before the other like Arab or Islamic countries. Also, the difference between the Islamic banking application when it starts like 100 years after the modern banking establishment in the Islamic region. So it's interesting to know how far it takes to start like such new application. And we have like some for adopting Islamic currency, Islamic things. We'll have some review and then following by a conclusion. First, we can describe the fintech or financial technology as a terminology used to describe new technologies that seek to improve and automate the delivery and use of financial services. Islamic fintech is no different, but it will be built on the principle and values of Sharia and has the potential to revolutionize global finance. Most notable benefit of Islamic finance or of Islamic fintech is its open, simple use and transparent. The number of financial service in fintech can be like cryptocurrencies, our research topic, blockchain, and other areas like cross payment, border payment. Due to the fact that Islamic finance is still in the early stages, there are a number of regulatory challenges, including changing the regulatory framework, the conflict with one already in place. Because as we will see, it is still not regulated in many Islamic countries. Cryptocurrencies has been tackled in the literature. For instance, from the Islamic point of view, some Yusuf and Farsi cryptocurrency has been defined in as a digital medium of exchange in place of fiat money. The cryptocurrencies, as you know, relies on blockchain technology to provide safe, traceable, and unchangeable financial transaction. From an Islamic perspective, money shall be abundant and freely available. Money shall be durable, does not spoil or corrode. Money has intrinsic value. Money exists in creation. Is made valuable by God. Money function as a medium of exchange. So, for a mean or another, money must be a valuable thing. In Islam, it doesn't happen to be like a virtual thing. From the literature, many authors tackle the pros and cons of adopting Bitcoin as an alternative currency. For instance, in Malaysia, the challenges of adopting this currency or any other cryptocurrencies in Malaysia. King William, etc., investigated the customer engagement in gambling and stock trading and their willingness to trade in cryptocurrency. Actually, this paper is very interesting because they review the same customer who are willing to trade in the stock market or in gambling, and they ask them whether this same customer will be more willing to take the risk of cryptocurrency or to trade in cryptocurrency. And EJIF considers the security risk of volatility and liquidity problem associated with the cryptocurrencies applications. Some other answers in the literature considers a drastic fluctuation of the cryptocurrency, because as you know, in Islam, it's will be like a fraud if you are trading in some unexpected or very risky environment. So this was a concern. Some other propose the concern or analyze the concern of the utilization of cryptocurrency, money laundering, and other illegal purpose. And by the way, it's the same for the fiat money. So if it could be an issue in the crypto, so it's still an issue in the fiat money. It doesn't matter. Some other issues suggested that banking service vary regionally, creating inequalities in the ability to access to credit, etc. And I guess my previous colleague tackled this topic, the issue of digital transformation and digital divide correlated with the banking industry in this regard. So if the most developed countries will get like access to such banking service more than the less developed, and within the same country you will find that the urban area has more banking services than the rural area. So this is like a challenge for the cryptocurrency to face. In this section, we will review the evolution of the modern bank system in Western and Islamic banking. Modern banking was known today had its root in the laissez-faire philosophy of British economist Adam Smith, who advocated for a much more free market approach to banking, being ruled more by the invisible hand of marketing force. The Treaty of Paris admitted Turkey to concert Europe on the basis of reaffirming Turkish promising of long over. I have mentioned Turkey as a starting point because from the literature, the first Islamic banking or the first Islamic country to have like a bank border system banking was in Turkey. So it seems that it has been like formulated or established to organize their own credited by the Western countries toward Turkey, and then it started from there. In the next slide, we sorry, can see in Egypt and Tunisia, two countries. Also, it started far in the 19th centuries. In Egypt, the first bank started between 1850 and 1876. In Tunisia, it started between 56 and 76. In the next slide, we will have like a chart for the evolution of the banking industry. You find that the first bank has been in Italy in 1407, in the 15th centuries, and then the United Kingdom in the 17th century under the name of Bank of England. And then the first Islamic bank came like 1 century afterwards in Indonesia. Bank of a Dutch bank was established to organize the Dutch trade in Indonesia, and then following the Bangladesh and then Turkey, as we have mentioned, the Ottoman Bank, and then in Egypt, the first bank was established in 1864, and actually found that the Gulf area started this banking system like 1 century after Egypt and Turkey. So there is like a gap between the Islamic countries to adopt the same new idea or the same technology, whatever. Then in the next slide, we will shed light on the Islamic banking, like the establishment of the Islamic banking started in 1963. The first modern Islamic bank on record was established in rural Egypt by economist Ahmed al-Nagar to appeal to people who lack confidence in state-run banks. And the current status of the Islamic banking is very flourishing. That you know, it's a very growing industry. So reached almost 4 trillion US dollar in 2021. In this chart, you'll find the gap between the first establishment of an Islamic bank and the first bank of the first modern bank in the same country. So you'll find, like in Indonesia, it started in 1746, and then the first Islamic bank in 1992. So it's almost 200 years or more. In Egypt, for instance, it started in 1863, the first modern banking, and then in Turkey, 1863, and then the Islamic banking started in 1985. In Egypt, it's very also wide, between almost 100 years, between 1864 to 1963. Maybe in the, as I have mentioned before, the Gulf area, we didn't find a very huge gap between the Islamic and modern banking, as if they were starting at the same time. But in Asia, in Muslim countries, and in Turkey and Egypt, there is a significant gap between the two. This chart, we just analyze or demonstrate the growth of the Islamic banking industry. You'll find that it almost reached like 100% growth between 2015 to 2021, which is a very significant rate. That might be, in some literature, refer to the 2008 financial crisis as a turning point for many people to trust trade or to Islamic finance. And the next slide, we will focus on the Islamic Fintech values, which based on the Sharia has the ability to lead the financial world across the globe. The biggest advantage with Islamic Fintech is the transparency, accessibility, and ease of use. According to Global Fintech Report 2023, fintechs grow owing to expand customer access to financial services. Fintech funding surged to $450 billion between 2014 and 2020. This slide demonstrates the digital payment variance between in some Islamic countries. You will find that some of them, like Turkey and Indonesia, are much more developed than, for instance, Egypt and Malaysia. I haven't considered Qatar and UAE because they have a very small population in comparison with Turkey and Indonesia and Saudi Arabia. But Egypt and Malaysia have a very big population, and they are still lagging behind countries like Turkey and Indonesia. And we will find that some of the reasons for that may be the regulatory obstacles. The next slide, we demonstrate the top 9 Islamic fintech countries in the global Islamic fintech index. You find that Malaysia is the top-ranked country as per the Islamic countries, followed by Saudi Arabia, and then UAE and Bahrain, and Turkey came like ninth in this chart. Following, we will demonstrate that from our research, we found that some Islamic countries are yet to recognize cryptocurrencies as a legal tender, like in Egypt, Morocco, Turkey, and Algeria. Other countries are currently developing their own system of cryptocurrencies, like Saudi Arabia and United Emirates, and some other countries authorize financial assets, but the cryptocurrency as a financial assets, but not as a way of payment. And this is the case of Malaysia and Indonesia. Alternatively, Iran has a complex relationship with cryptocurrency. In 2019, Iran's central bank banned trading of cryptocurrencies inside the country, but the government allowed the use of these countries in paying for imports. So in this table, we classified these countries into like three categories. One of them, Indonesia and Malaysia, are regulating of this cryptocurrency by a way or another. Is it related? Saudi Arabia, Iran, and UAE are working in progress, are working in the process of regulating this market. Qatar, Egypt, and Turkey, it's banned, and there is no any steps taken to regulate this market until this moment. So in the next slide, we consider the growing loyalty programs promoted by mobile companies, by flight companies, etc. This loyalty programs could be used as a mean of circulating the cryptocurrencies in the Islamic world, because it's this programs is already in place. So if you could encourage the companies to promote the cryptocurrencies via these programs, it might be rapidly circulated. So blockchain technology is making a significant impact in the program, with various the way they operate. While cryptocurrencies have a considerable attention, the potential of blockchain reality and customer relationship has been less explored. The blockchain-based reality program already claims over 300 retailers on board, including Catch.com, Contech, Europcar, etc. The whole system are merging at a rapid pace, with individuals adopting credit card rewards in the form of bitcoins, stable coins, and other cryptocurrency tokens over online miles, hotel points. Discussion of this paper is one of the main Islamic concerns regarding the provision of cryptocurrencies in Islamic countries is the lack of supporting regulatory bodies as the central bank, in addition to the fluctuating exchange rate of these currencies that make it very risky to be used as a mean of payment or a value recapture asset. Respectively, the integration of the company's loyalty programs with the cryptocurrency could provide some sort of advocacy regarding the regulation of these currencies. In conclusion, to conclude, the history of the promotion of modern Islamic banking system to the Islamic world varies from one country to another. Accordingly, the Islamic banking system started like in 1963 in Egypt, while the modern one started in 1863. Undoubtedly, trading in cryptocurrency is risky, yet millions of dollars were invested in this notably unregulated industry, leaving trader there without protections. So the blockchain intends to offer benefits as it's secure, efficient, hard to hack, etc. So money must be reliable, secure, efficient to be like accepted in Islam, or according to Islamic Finance rules. And then the final conclusion. Next slide. The next slide. Sharia compliant currencies must abide by moral and ethical standards like justice, transparency, and social responsibility. when cryptocurrency enters circulation, there are many ways to get it. Can be purchased through exchange. Some people accept it because their companies allow them to choose to receive digital money. Some retailers accept cryptocurrencies as payment for their goods, services, or people or organizations who maintain the blockchain for cryptocurrency are usually rewarded with cryptocurrency. Thank you.
Thank you, Karim. It was a very informative presentation on cryptocurrencies and Islamic finance. You raised some really good points there, especially I think the uptake of Fintech in the Islamic countries is slightly slower than the rest of the world, but it's getting there. And as Ilinka had very rightly pointed out, the transformation of the financial landscape, especially within Islamic finance, there is no stopping it. I mean, there is, even if we agree or not, the governments will have to really conform to it. And you highlighted the dichotomy within the Iranian system where the government is using crypto for imports, yet within the consumer markets, they're not really allowing it. So yeah, it's all very interesting, and I think we're living in very interesting times, and we are seeing the transformation of our lives through social media to the inclusion of AI within business sectors. So I think all of this really adds to the body of literature which is being developed by scholars like yourself and Ilinka, and I thank the university for hosting this forum. And this journal is definitely going to add to the existing body of literature on Islamic finance. I think that all of us, whether somebody like me in the legal sphere or other financial or economic scholars, we are all very keen about the development of technology that we see this transformation come about. And I think what Islamic finance is doing is it's giving an option to the world that there is, regardless of the theological differences, there is an opportunity for more ethical and a more equitable world out there if we all choose to become part of it. I thank both the organizers and facilitators who hosted and assisted this presentation this morning here. And thank you all. I believe if we all have each other's emails, if there are any questions, we can always exchange emails, and of course we can share some ideas. Thank you so much, everyone, and it has been an honor and a privilege to be here with you this morning. All the best, and thanks once again. Bye for now.
Thank you so much, and we wait for you in the keynote speech.
Sure.
Okay.
Okay, bye.
Bye.
Thank you.
Bye. Thank you.
Bye. Thank you, everyone.
Thank you. Thank you. Thank you.
Thank you.